You couldn't qualify at those rates. There was no way to qualify. So if you got a loan, you were ecstatic. The point being, the good news is I don't think we're going to see that kind of draconian policy coming from the Federal Reserve. But again, we have to get used to the idea that, hey, money markets at 3, 4, bond yields, the good news, we manage a lot of bonds, Steph will talk about in a moment. The good news is yields are moving up on fixed income. But we have to begin to realize that no, the easy, sloppy, cheap, 0% money is gone. And you know what, in my personal opinion, I think the government kept it on way too long. That was supposed to be on 2008-9, and I think that there was just no political will to move rates back up. I'm not blaming anybody. I'm not trying to take a partisan view, but that should have been stopped in about 2011. It really should have. It should have. We're moving things back up, but the Federal Reserve just left it alone. So anyway, a couple other quick things. Changing investment landscape. Now I'm going to cover stocks. Steph's going to jump in on the bonds, and then of course we have people in here who know a heck of a lot more about real estate, but I'll just tell you what I see and what I think have to consider. So, stock market. If you read my last Forbes article, we have this kind of surreal situation going on right now where, you know, the NASDAQ is, I basically call it the mother of dead cat bounces after what happened to it. Sorry if anybody here's a cat lover, I apologize. But anyway, you know, it was mauled last year, it was badly hit. The NASDAQ is still nowhere near to its high of last year. It still has another, I think, 18 to 20% to go. So it's been a heck of a bounce. But the point is, what's more concerning to me, and what I wrote is at some point, all the horses have to be pulling in the same direction. What should concern everybody in this room is that we have a divergence going on where you have the NASDAQ do this, but the Dow is this, mid-cap stocks, small-cap stocks, we have our own proprietary index that tracks the older stocks. Up 2% on the year, 3, not 30. That should be a concern. For those of us who remember 1999, you don't want divergences. They end one of two ways, and we don't want it to end the bad way. But I'm just saying, when you ask why are we so cautious, that's why. I don't like what I'm looking at in the markets right now. I see a lot of volatility. I'm seeing, and by the way, the leadership's shifting around daily. I mean, company to company. You'll see companies that are they're doing great, and suddenly they get hit. All this talk about artificial intelligence. My friend Alex, he works in that in Google. I mean, the AI stocks got creamed the other day. So there's just this volatility, and then you throw on top of it summertime activities. I've done the studies going back to 1970, and I can just tell you all, it never hurts to hold some cash back during the summertime. Go enjoy yourself, put some money, hopefully get a little bit of interest, but try to push summertime stock investing. It can be a very tough task. The markets just typically have a lot of volatility, so you should think about that. I think I'm going to end on that. We're going to talk later about other things, but let me just, one quick thing on bonds, and then Steph's going to talk a lot. There's no such thing as a bond market. They're bond markets, plural. We focus on corporates. That's a different thing, but I want you all to think about this. You and I just literally met with our county supervisor, Eric Lucan, and he and I had lunch. And I literally asked him, I said, Eric, has anybody in Sacramento considered what's going to happen when California has to refinance all of its debts at today's levels? And he kind of looked at me like, you kind of got like that dead trout look. You know what, that was the point. It was, they don't want to talk about it. I don't know. It is not, but I said, Eric, you guys have bonds that were financed at 1.5%. You guys are now going to have to finance it at 3%. Okay, that's double the borrowing cost. How are you guys going to pay for this?
They're not.
Well, yeah, their answer is. Well, the problem is California already has the highest tax in the country, and so I'm of the opinion that you can only push this so far, especially with people retiring. Rocky, I know we'll talk about this more in this presentation, but no, I think that we have to consider that there's going to be a serious problem on this municipal refinancing. Companies will not have the same problem. Companies have the ability to pass on, we don't like it, but they can raise their prices. And usually if you need their product, you can't. I just think that a lot of states, counties, school districts, water districts, Melrose, toll roads, you name it, are going to have a very, very tough time trying to pass on those borrowing costs to the taxpayers. especially in California. So that will be what I'll say there. But Steph?
On that bright note.
Yeah. Well, let's talk about good now, yeah.
Rainbows. Okay, so I'll talk about the fixed income for a little bit.
For the first part of the century, I think we can all agree, 0% money, I don't think any of us in this room will ever see that happen. Yeah, that's just, those days are over. I would also just bring up one other thing, none of us want to think about it, contemplate it, but what did happen in the last rounds of stagflation is that taxes go up. The last time we had a 40% capital gains tax was in the 1970s. So unfortunately, and I'll talk a bit more in a moment on this, but we do have to accept that, and it's actually interesting, the government doesn't like to include rising taxes as an inflationary item. I would argue it hits everybody, but they don't include it in their statistics. But we have to accept that these are some interesting waters. Now, they can be navigated. You know, that's why you pay us to try to figure through it. But again, there's just a lot of interesting crosswinds we have to deal with. Item number 2, normalizing of interest rates. And I say normalizing, I mean, I find it, especially for younger people, to say, the rates are going up. Well, they are, but 0 interest rates was never normal to begin with. And so now I call it we're normalizing. It's not they're doing, I mean, for anybody here remember the late 70s, early 80s? Anybody try to buy a house then?
Yeah, 11%.
Yeah, you 11. Well, you had a boy, Rosh, a friend was a
There was a GI loan probably.
But you know, it was interesting. My dad and I talked about it, and he said, "Hey, I was happy to get a loan. You couldn't qualify at those rates. There was no way to qualify. So if you got a loan, you were ecstatic." The point being, the good news is I don't think we're going to see that kind of draconian policy coming from the Federal Reserve. But again, we have to get used to the idea that, hey, money markets at 3, 4, bond yields, the good news, we manage a lot of bonds, Steph will talk about in a moment. The good news is yields are moving up on fixed income. But we have to begin to realize that, no, the easy, sloppy, cheap, 0% money is gone. And you know what, in my personal opinion, I think the government kept it on way too long. That was supposed to be on 2008-9, and I think that there was just no political will to move rates back up. I'm not blaming anybody. I'm not trying to take a partisan view, but that should have been stopped in about 2011. It really should have. It should have. We're moving things back up, but the Federal Reserve just left it alone. So anyway, a couple other quick things. Changing investment landscape. Now I'm going to cover stocks. Steph's going to jump in on the bonds, and then of course, we have people in here who know a heck of a lot more about real estate, but I'll just tell you what I see and what I think have to consider. So, stock market. If you read my last Forbes article, we have this kind of surreal situation going on right now where, you know, the NASDAQ is, basically call it the mother of dead cat bounces after what happened to it. Sorry if anybody here's a cat lover, I apologize. But anyway, you know, it was mauled last year, it was badly hit. The NASDAQ is still nowhere near to its high of last year. It still has another, I think, 18 to 20% to go. So it's been a heck of a bounce. But the point is, what's more concerning to me, and what I wrote is at some point, all the horses have to be pulling in the same direction. What should concern everybody in this room is that we have a divergence going on where you have the NASDAQ do this, but the Dow is this, mid-cap stocks, small-cap stocks, we have our own proprietary index that tracks the older stocks. Up 2% on the year, 3, not 30. That should be a concern. For those of us who remember 1999, you don't want divergences. They end one of two ways, and we don't want it to end the bad way. But I'm just saying, when you ask why are we so cautious, that's why. I don't like what I'm looking at in the markets right now. I see a lot of volatility. I'm seeing, and by the way, the leadership's shifting around daily. I mean, company to company. You'll see companies that are they're doing great, and suddenly they get hit. All this talk about artificial intelligence. My friend Alex, he works in that in Google. I mean, the AI stocks got creamed the other day. I mean, so there's just this volatility, and then you throw on top of it summertime activities. I've done the studies going back to 1970, and I can just tell you all, it never hurts to hold some cash back during the summertime. Go enjoy yourself, put some money, hopefully get a little bit of interest, but try to push summertime stock investing. It can be a very tough task. The markets just typically have a lot of volatility, so you should think about that. I think I'm gonna end on that. We're gonna talk later about other things, but let me just, one quick thing on bonds, and then Steph's gonna talk a lot. There's no such thing as a bond market. They're bond markets, plural. We focus on corporates. That's a different thing, but I want you all to think about this. You and I just literally met with our county supervisor, Eric Lucan, and he and I had lunch. And I literally asked him, I said, Eric, has anybody in Sacramento considered what's gonna happen when California has to refinance all of its debts at today's levels? And he kind of looked at me like, you kind of got like that dead trout look like, you know what, that was the point. It was, they don't want to talk about it. It is not, but I said, Eric, you guys have bonds that were financed at 1.5%. You guys are now gonna have to finance it at 3. Okay, that's double the borrowing cost. How are you guys gonna pay for this? Well, yeah, is what their answer is. Well, the problem is California already has the highest tax in the country. And so I'm of the opinion that you can only push this so far, especially with people retiring. Rocky, I know we'll talk about this more in this presentation, but no, I think that we have to consider that there's gonna be a serious problem on this municipal refinancing. Companies will not have the same problem. Companies have the ability to pass on, we don't like it, but they can raise their prices. And usually if you need their product, you can't. I just think that a lot of states, counties, school districts, water districts, Melrose, toll roads, you name it, are gonna have a very, very tough time trying to pass on those borrowing costs to the taxpayers, especially in California. So that will be what I'll say to that. But Steph?
On that bright note.
Yeah. Well, let's talk about good now, yeah.
Rainbows. Okay, so I'll talk about the fixed income for a little bit. I think one of the big changes that I've seen this year is the amount of risk that has come into that space. You know, normally, if you've heard me talk about this before, fixed income is normally boring. It's not something that people talk about as exciting. You know, they'll talk about crypto, they'll talk about their stocks that are doing great, you know. We can have a laugh about Tesla or something like that. But you know, you don't walk into a party and go, oh, I have this bond, it's paying me 5. Love it. And so it's just not that thing. But I feel the landscape's changed quite a bit. And what has changed for Ken and I the most is our view on risk when it comes to bonds. So I feel bad for the companies the most. They've been through a lot the last 3 years. Just look at the last 3 years. Any given company, it doesn't matter. You have COVID. Could the company have its employees shift to work from home? Yes, maybe, maybe not. Maybe they had to come to work, not sure, but there was a pivot, right? And we had a nice little Goldilocks after with the recovery, but we're still trying to work through it. And there were supply chain issues, right? I remember driving across the Golden Gate Bridge and seeing ships, tankers in the bay, waiting to unload, right? We couldn't unload anything. Triggered inflation. Inflation was happening. Prices of everything went up. Companies were trying to recoup what they lost during COVID, passing those costs down. And now we have a credit issue. So companies that maybe could pivot through COVID, maybe got limped through the supply chain issues, maybe are dealing with inflation and passing costs down. Problem is consumers are changing the way they behave, right? So maybe you're not shopping as much or your shopping's changed, right? So these companies, to track and to really forecast what they're gonna earn and their cash flows, that's getting harder, right? And now we have a credit crisis. We had SCB, we had Credit Suisse, we had First Republic. You've heard me talk about it. Obviously I worked for First Republic. I'm really upset because I didn't think that was required. It's not my say, but you know, Chase got a good deal out of that one. So the creditors are the ones that got screwed, not Chase. And I know a lot of people at FRB, and I feel bad for them. They're coming into the market, they're looking for jobs. Not a lot of them got to keep their jobs. So, you know, the space for fixed income has really turned into actually a company by company basis. You know, sometimes you can look just at sectors, sometimes you can look at maturity length, you know, you look at the fundamentals of the firm. But now when it comes to risk, it is actually company by company. You know, are you having cash flow issues? What's your debt to cap? Are you going to be able to refinance? Because banks now, Ken can attest to this better than I can. He can probably cite every single one of them. When banks stop lending and there is a credit crisis or credit crunch, that's when the economy has real problems, right? So the company might be okay, it might have limped through, but if they can't refinance and get more backing, well, that's when everything comes to a head, right? So when we are evaluating the 120-ish names on our portfolios that we watch, because each one is gonna be situational, and you have to look at it actually on a daily basis, and that's what I do. So my job focus is turned into the portfolio management, but really risk management. Are we comfortable with what we have on the books, right? Because once you look at that landscape, you then have to go client by client and go, can I get them what they need? Can I get them the yield they need? Is it risk averse for them? Every portfolio we make is custom. So we have to make sure that I can build whatever it is that each client needs to satisfy that need with keeping risk in mind. Am I comfortable with the amount of risk in the portfolio? Do you have too much? We have special situation bonds that we always kind of consider where we allow a few of them in our portfolios, not too many, because they're higher risk, but with that higher risk comes higher yield. So you have to really balance that landscape, and in the meantime, the actual credit quality of the bonds can change quarter to quarter. So staying on top of that has really become my #1 focus in my job.
Absolutely. I'll just add a couple other quick points, and by the way, I'm glad Stephanie brings up, people used to say bonds were boring. If you think about it, there's a lot more going on there. And it was funny, I was telling some other gentlemen in the room, I don't know where Wall Street got the brilliant idea of let's buy and hold stocks through everything and let's trade bonds. Well, wait a minute, a bond has a date when it comes due, and you know exactly how much interest you're getting. You're gonna trade that, but then you're gonna just automatically always buy and hold anything through thick and thin. It should be the other way around. It doesn't mean you don't look for stocks, long-term investments that make sense. But when things start going wrong, you get rid of them. You just say enough and go. It's interesting we talk about what happened here with First Republic, certainly with the Signature Bank, which I find comical that one of the folks who was one of the authors of the 2008 bill was on the board of that bank, Barney Frank. It just kind of comical in its own weird way. And then of course Silicon Valley Bank. I know one of the gentlemen in the room here, Jake, I mean, we talked about Silicon Valley Bank. That was, how do you describe it? This was the Goldman Sachs of the Bay Area. This is who you wanted to work. You come out of grad school, you wanted to go to work for SVB. Who would have ever guessed? But they would have made such monumental errors and just blew up. But think about this. For those of you who remember when oil busted in the early 80s, remember when suddenly oil went down, people thought, well, because inflation was finally dying down. Guess what blew up at the same time? Texas banks. Do any of you remember that back in the early 80s? Houston became a ghost town. Banks were blown up left and right out of Texas. Why? Very, very bad bets on oil. And I mean big banks, huge banks that were comparable in prestige to what happened here recently. So again, when you have changing interest rate environments, that switches things around. Hey, I forgot to bring up one quick thing about the situation with the munis that I just want you all to think about. The one big difference between now and the 1970s, the one big one, was when you had a tax-free muni bond in the 1970s, it was really tax-free. I mean, that was tax-free income. Any of you here ever heard of a little tax called AMT, Alternative Minimum Tax? Well, guess what one of the losses are when you trigger AMT? Municipal bond income suddenly becomes taxable. Yeah, think about that. So that 3% tax-free bond, you itemize your deductions, you have a few too many, suddenly it's now a 2% yield, part of it. And I do think if we'll have some people later talk about the tax thing, but I do think it's safe to say that AMT is one of those things that politicians like to play with, especially an elected issue, and I would not be surprised to see the brackets lowered again. That would not surprise me at all. We're going to have people up here talking about real estate, but I do think it is an incestuous relationship when you think about bonds, and certainly of all sections, and what's happening in real estate. I just came back from Pittsburgh, and it was interesting to see just differences on how money's being spent. They're revitalizing their streets, they're doing everything, they're trying to facelift buildings. I had the privilege of going out to Salt Lake City not long ago. Beautiful, clean, construction cranes are up. Las Vegas, you all know the story there, growing like mad. And yet when I come back to California and I look at like San Francisco, And it feels dirty, it feels like it's a bygone era of success. I feel that way about Los Angeles. I mean, it doesn't feel like money's being spent to fix things that we all really need and care about. That, again, I think real estate's gonna become very, very geographic. And I think today, we'll have a gentleman talking about, certainly, Edward, I'm sure you're gonna have some points to make on that too. Commodities, very quickly. I think, not to say everybody here needs to rush out and open a commodity future account, but I would say this, commodity-based companies, now there's seasonality to them. You know, anybody here grew up on a farm know there's a harvest season and there's a planting season. They're trade, but I do think that the leadership within the markets will continue to go towards some of these older style companies. I remember at one point in time, it's funny when you get these calls, Steph and I will somebody said, Ken, what's this company? It's called Archer Daniels Midland. Is that a consulting company? I said, well, do you eat soybeans? I go, oh, sure. I said, the reason you eat soybeans is because of a company called ADM. Go out to the Central Valley. Go look at who one of the big employers is out there. So those points you have to make. I get asked quite a bit about crypto. I would just simply say this, it's a generational thing. I think there's a lot of younger people who are enamored with it. And all I always say is, look, I'm an old commodity trader. If you want to do crypto, treat it in a pool of commodities. Think of it with other things, with other currencies, gold. Just put it in that spectrum if that is something you truly want to be in. And then last but not least, foreign markets. I know people are thinking that because there have been times where the foreign markets do better than the US market. It's a little bit of a competition with what's going on with currencies. Remember that a lot of times it reflects, if the dollar, I mean, people say the dollar's getting hit. The dollar just basically had gotten slightly overpriced, and now it's back into a normal range. It's hardly what I would call a serious devaluation, but I still see a very mixed bag globally in the markets. And I know that I don't think anybody here wants to rush in and suddenly start put your money in Europe or the Middle East. I don't hear that clamoring to hurry up and get your money out of the United States. I still think people buy into the argument that the rule of law, the fact that companies here are global. If you buy a US-based company, whether it's private or public, chances are they have foreign clients. I think those are things you want to begin to think about. We're going to take questions here in a moment, but I'd like to jump right in, if it's okay, with what we're calling investor psychology. It's been a trip post-COVID. It has been a trip. I mean, I think it's kind of interesting. It used to be isolated confinement used to be a form of torture. We as a world decided to do it for 2.5 years to ourselves. We can argue about it, the historians will battle it. Was it right, wrong? Was it worth what happened in the world economy? We're not going to argue that today, it's too soon. Let the historians sort it out. But what I would tell you is that I do still sense anger with a lot of people, impatience. You know, people want to get back to normal. I want to get back to normal. And normal is different. I think we would all agree with that. These are my impressions, by the way. By no means, I'm not a doctor. I call it tight money stress. I'll give you an example. It's just interesting. We had a line of credit with Union Bank. Here's just a prime example. The company's been around for 30 years. Union Bank came in 60 days before our line was due and said, oh, we're not lending money anymore to financial service companies. And I turned to my guy and I said, aren't you a financial service company? He goes, well, yeah. I said, so you guys would not loan to yourself. What happened? Real estate brokerages were going out of business. So they took everybody in financial services, said, nope, we're not going to lend any more money to anybody in financial services. Crazy. But it causes stress because you're used to, what did I do wrong? Didn't do anything wrong. It's just the nature of the beast. But that's going on left and right. Think about people trying to qualify for a mortgage right now. You know, not everybody qualifies. So you have that going on. Stephanie, I know you wanted to talk about technology.
I was actually going to touch on psychology too for a second. One of the things that I'm getting a lot of calls about from our clients is that just general fear, right? When everything with COVID happened and everything since, the market's been really volatile. It's something that we haven't seen, not for this prolonged amount of time, not for a while. And I think clients are just tired of it and they want it to kind of snap back and don't feel that pressure anymore. Is something going to blow up on my account? Am I going to have enough in there? Is something to go wrong? And that fear is, I think, dictating people's opinions about what to do. You know, whether they're politicizing their portfolio because they're scared of what's going on with, you know, federal policies or whatnot, or if they are scared if another bank run's going to happen. Whatever it is, the bottom line that I'm sensing from probably about 2,000 clients that I've talked to over the last few weeks is they're exhausted and they're tired. and they're scared. And I think that's just one of the things of trying to manage through this till we get to a point of either another Goldilocks or where things are just more stable. It takes discipline. You don't wanna be herky-jerky with your portfolio, you wanna do radical allocation changes. I think steadying the course and then leaning on the professionals that can help you navigate what's going on is one of the things that we're really focusing on with all of our clients.
Absolutely, yeah. And also, I think since we're so close to the wineries, I think those of us who are in this area, we probably have all partaken a little bit more of the local agricultural products than we used to. But I would also say too that I will call it the general misuse of technology. I'll give you an example of this. Okay, well, I mean, the brokerage houses have poured a fortune into their technology. There's one problem. When I look at the portals at a place like Schwab, they're geared for equity. They're geared for publicly traded equity. And boy, they're great. You pull out your phone, you can see each and every day. Now we can argue, I wish people wouldn't do it. Because usually when you do it's on a bad day. Okay, which means you're mad, like this thing. You can't help but say, why is it red? Yeah, no, you keep, I mean, it's almost like you're in a casino. You're looking, oh, I'm losing today. But the problem is that it is terrible, and I dare say terrible, on other types of investment mediums. Can you imagine if we tried to add, I mean, commodities to it, forget it. We're gonna have a talk today about private equity. Imagine if Schwab added private equity to their portal. How would they evaluate it? They wouldn't, I mean, it gives bad information. But the number one way we see it poorly constructed is with bonds. The price, remember, bonds come due. You have a bond, it's a loan, you lent money for 3 years, you get $1,000 a bond back when the bond comes due. The company itself has to pay, not the market. The problem is, what the technology shows you, it would be the liquidation value of that bond at that moment in time. Well, guess what? Bonds don't trade all the time. This is how bad it was at one time. I remember I got a call, this was 15, 20 years ago. A client was panicking. Ken, I gotta talk to you right now. I thought something was wrong with his family. He said, there's a bond in my portfolio that's priced at 0. That's news to me. I said, a gentleman named Dennis. I said, Dennis, he says, McDonnell Douglas. I said, Dennis, McDonnell Douglas is still in business, but what happened? That bond didn't trade that day. So what did Schwab do? 0 value. Yeah, we're laughing. I mean, but I try to tell people, look, when you're looking at your portfolio, it's very complicated. A lot of complicated pieces in what we do. And so I tell people, in the case of your bonds, those portals do not show you what the total amount of interest you're gonna get for the year. They don't show you what the bond's gonna be worth when it comes to it. It's giving you a snapshot as if you were to sell it right this minute. This is what you would get. And by the way, it might not even be an accurate price. So I tell people with their bonds, treat it like you would Zillow on your house. Any of you look at Zillow? Okay, okay, all right. Do you look at, all right. Do you look at Zillow daily? Don't. Yeah, let's just say I would highly recommend it. You want to add anything to that, Smith? Or, no, does that make sense, folks, what I'm talking about? I'm just saying, don't let the technology stress you. I'm just trying to say that to you. Our Tamarack portal, we've spent a lot of money and time setting up a structure on how to look at your portfolio the way we think it should be looked at. But to be jumping around, panicking with your phone, you know what? Maybe there's something more to the story that we're just not thinking about.
Actually, I'll give a real world example. So I was going on vacation last April, and I was trying to buy a bond, and it was the last hour of the trading day. And the broker dealer was working on the opposite end of the deal with not the normal person. He was some kid, some analyst that was filling in that was going to handle the trade that day. And the kid goes, well, I don't know what I should price it at, so I'm going to just put it at 95. And my BD knew that it wasn't worth that, it was worth like 92. And she's like, well, if you wait till Monday while you're on vacation, well then I'll work it with the normal person, I'll see what I get. Okay, so the kid said 95 on Friday. On Monday, I bought it for 92 and an eighth. So you save almost $3 just simply because you're working with someone different. And I feel like because bonds trade like you trade a house, that relationship and who's willing to make the deal on that day really does affect the pricing. And it's why patience when you're building portfolios really matters.
Absolutely. Absolutely. And then also too, just one thing, when you buy a bond, you have to pay the previous bondholder the interest owed. So people say, you just bought that bond, it's down 4%. No. You'll get that all back. It's a receivable. You'll get it all back when you get the interest payment. But again, the systems don't account for that. So one that Stephanie and I are a little leery to bring up here, but let's talk about the media. Financial media used to provide information. I really do not care about a journalist's opinion of the stock market. They are not experts in finance. They have unfortunately become celebrities. And unfortunately, they are not following Walter Cronkite's old maxim. For those of you who remember Walter Cronkite, he just reported the news. His personal opinion didn't matter. They can't help themselves. But we are finding that a lot of this angst amongst people is fueled by the media. And I think we all feel that way. Whatever end of the spectrum you're on, I think we all feel that way. I personally have turned off the media. I read the Wall Street Journal, Investors Business Daily. I'll read it. Forbes. That's right. Thank you. Yeah. Oh, and by the way, Forbes is actually. It's been interesting. They try to guide their writers into going into certain areas. And by the way, I love how you're all looking at the ticker up there, going, "Oh shoot, what's going on with the Home Depot there?" No, I'm just kidding. But here's the point. We are having the mixing of economics and social policy. I think they're strange bedfellows. I don't think you can completely look at them in isolation, but I'm just suggesting that maybe it would be wise, especially with social media sites, to maybe question who put it out, who put out that story, why, what was the agenda. I'm getting more critical of it all the time when I hear and read something, and Steph, you want anything on it, or you pretty much, I mean, you have to be careful on these things. Again, that anger, that post-COVID anger thing that we're dealing with. But I think it has to be said. I just go back and question what you're being told and why. And don't necessarily make reactive decisions, especially with money, based on that. Financial service issues. Okay, Ann will talk about Schwab later, but this consolidation in financial services I think is going to continue. Bank branches, I think we'll get to a point in life where there's very few of them left. It is interesting. I do find it comical that things like sending wires seem to be overly complicated today. I mean, Brittany and I have had to go to the bank a couple of times to get things done. I have more fun going to my dentist to have my teeth cleaned. I mean, it's just ridiculous. It's almost, I mean, it was faster during the Pony Express days in some cases. So you have that, but there is a sense, the really good thing that I think we as consumers are pushing is justification of things and how money is spent, and especially when you think about, in the case of in financial services and wealth management, financial planning, how are you different? What are you doing to make things different in my portfolio? What makes it unique? I do think that people are driving that more and more and more when they look at who they have working for them. Because again, in tighter markets, you need to work with people who actually know what they're doing. Going into there, I'm going to say a couple of final points here that I would just call it that radical rethinking of investment strategy. Part of the panels we have today are people in different areas, whether it is in, Rocky will talk about wealth management in general, but we have to talk about real estate, different ways to look at investments there, private equity. There are other areas that people should look at besides just public investments. You know, I always say that we're a core. There's an area out in the tail that you should always look for opportunities. And right now there are opportunities out there. That is the good news. There's a way to make money in this situation, but you have to pivot, you have to think differently. And don't just say, I'm gonna hope and pray that the old world returns. What if it doesn't? You know, this is the new norm. It does, again, not good or bad, folks. It's just saying, rethink things, meet with your advisors and say, hey, how do we navigate this world? Okay, positives. What's new at Winans? Well, one of the things is that I guess we're considered pretty good at what we do, but we're getting a lot of institutional type investors, wealth management firms, that are hiring us to actually manage portfolio on behalf of their clients. So that's a growing area for us. And I've been wanting to do it for quite a long time. We actually set up a commodity trading advisor business called Winans Trading. Admittedly, it took longer to do than I thought it is, but I still think there's money to be made in trading commodities, and I will be coming back around on that. Again, I believe that is an area that we have to look at. Morningstar continues to give us great rankings. We appreciate that, but it is we have to keep earning our keep there. Vegas. We have an office in Las Vegas. I'm going to be spending more time there myself personally. But it is amazing, again, this migration out of California is the real deal. People are moving to places like Salt Lake City, Las Vegas, Arizona, Boise, Idaho, Texas, Florida, Tennessee. I have actually funny, I think we've had now 3 clients moving to Tennessee, which is kind of interesting, but they like it. They're buying lots of land cheap, and cost of doing business there is pretty low. You know, it's interesting, when I was in Pittsburgh, I was staying in Weston, and I went to the breakfast brunch. If you ever wanted to go into a money-making business, I always found it kind of funny why I have to spend $50 for a brunch at a nice hotel. $20. Now, if I went to downtown San Francisco, I think that probably would have been 50. You know, it's just cheaper. There's places where it's cheaper to live, and I think as people are getting older, even if they can afford it, they're looking for other places to go. I would just also bring up, I'm very proud of my staff. Brittany, where are you? She's hiding. Brittany just went through there she is. Brittany just completed a pretty tough compliance course. She's got it in her wall. Amy just went through a whole social media marketing, financial servicing. The point is we're learning. We're trying to improve ourselves here. Steph's doing the CMT. I'm continuing to study, and I mean, all of us have to. It's part of the game we have to do. So we're doing that. And then last but not least, our new website. I hope you all check it out, and if you find any typos, I don't want to hear about it. But we tried to put a website together that would help the client, and it would also help potential clients. So I think you'll all enjoy it. But we try to archive our articles, our research, and all the things we're going to do. So with that being said, I'm opening the floor up to any questions you may have. And unfortunately, we only have 1 microphone, so I will pass it around, I guess. Anyway, any questions?
For Stephanie. Yeah, no.
Ross.
No, it's an easy question. I see a lot of the bonds coming due and all that, and getting my money back and all that. But I don't see you guys, once you're buying it, I haven't seen you guys actually selling any bonds. And I was also interested in knowing more about, if you know any more about what's going on with Diebold.
Oh, yeah, sure, I can fill you in on that for sure. So, first part was reinvesting, right?
Yeah, if you're selling bonds, you were selling bonds before their, maturity.
Well, the thing is that, I mean, a couple things. I mean, I guess there are a few instances where we've sold bonds. There was a Sprint bond, I think it was 2 years ago, it was trading at 124, and if anyone that holds bonds knows how ridiculous that is. So we sold half. I mean, part of the enigma is, can I also then re-enter the market and find something comparable on the yield and risk spectrum, right? If I don't feel like I can, then selling it, unless it's for a premium, I'm just giving you the money earlier and gambling on the yield I can get on the next. In general, as Ken mentioned earlier, we buy and hold bonds. It's part of it's part of our strategy. It also costs, because there always is going to be a trade cost on the bonds as well. So there's a lot of factors that would go into why not. However, on the instance when bonds are at a significant premium, we do like to take in and capture that gain if we can. But it is always kind of a gamble. There was the Sprint bond that I'm thinking of pays 7.5, right? On coupon. I'm not talking yield to maturity. So trying to re-enter the market and find that specific kind of coupon at a price that I like, it's hard. The yields that I see on the newer bonds, or the ones that are more tradable right now, are lower. You're gonna see a lot of coupons in the 3, 5, 6 range. Yield maturity is gonna be 6 to 7, which is pretty much the sweet spot of what I'm buying right now. If you go over 7 to 8, you're probably going up the risk spectrum pretty high, and I really don't want to go there too often. If you stay, for example, in the 1 year range, if I'm gonna just buy, I want a short portfolio 1 year, you're probably about 5%. If you go to investment grade, about 5%. So there is actually, when I'm constructing portfolios for everybody, there's a lot of art that goes into it, of the balance between the maturity and the grade and the coupon and the yield maturity, and trying to construct something that resembles what I want it to be at the end. And sometimes the pieces in it might not make sense. And we had a newer client that just called me. He goes, that bond only pays 3%, why'd you buy it? I said, there's 2 columns in your report. There's the coupon, there's the yield you're gonna get, and then there's yield maturity, which was 7. So I said, you have to look at both, because you gotta factor in the fact that I'm buying it at such a discount, right? So that is a general policy. That tends to be the way that we manage. We don't see the benefit unless it's such a compelling story. And like the Sprint, where I walked in and I said, hey, we gotta sell this, because it's a lot, I'm gonna lock in 25%, who would do that, right?
I was also, I haven't seen you selling any because of the company, earnings going down or their ability to pay you back.
Yeah.
In that situation, I haven't seen you sell any of those kind of ones.
There's only 2 bonds that we've sold in the last few years that were because of risk concern. You're right, that is a completely different animal. If I see a company degrading and I have real concerns about its stability, then yes, then that's another reason why we would do it. A lot of times we try to cut the position in half and give the company a chance to recover. You know, a really good example would be QVC. So QVC is a little struggler.
Yeah.
They did a complete C-level reorg last September. And they're trying to change a little bit of the model and the way they're doing it. They're refinancing, they got backstopped. They're still under pressure on the longer bonds, the shorter ones are okay. Yeah. So we're watching it, we're concerned, I don't really wanna cut it, I still have faith, and you gotta sometimes let them work their way out. What happened with Diebold was really sudden and unfortunate. Diebold, if you bought that bond last year, it was trading at 95, okay? And the company itself, if for anyone who doesn't know what Diebold is, Diebold, back in the day, it's a 150-plus-year-old company, made safes. Now they make cash points. You go to Europe, you use a cash point, you go to any of the gas stations and you use the ATMs, that's what they make.
And voting machines.
And voting machines. And so, well, what Diebold did is they acquired Nixeldorf, I think 8 years ago, and they assumed all their debt. That's the difference between what happened with FRB. So with First Republic, Chase didn't have to assume their debt, so that's why the creditors got screwed. If they hadn't been seized and sold, then Chase would have had to assume their debt, and the credits would have been made whole, like with Credit Suisse, right? So Diebold did that, and they've been under pressure ever since. The problem is their debt became so heavy, and they were not gonna be able to pay back the bond that was due next year. So they went to their largest creditors. So they went to PIMCO, and they went to the Vanguards of the world, and they asked if it was okay to go into a structured Chapter 11 bankruptcy, right? So it's a 90-day bankruptcy. They're gonna come out, I think, in October. They had permission, they had the judge approve that it was okay, that they will continue to operate. They're not trying to close the company down. They have everything backstopped now. So they will come out of it, and they plan to repay the creditors as much as they can. We just don't know what that number looks like. I could have sold it maybe when it was at 20, but because the drop came really fast, or you can bank that on the restructure, you'll get maybe 60 or 70. I mean, that's kind of what we're hoping. But until they go through the negotiations and the financing and the restructuring, we just won't know what that's gonna look like. So patience, the thing is, it was such a quick decision because in February, they had a tender. We took the tender. We came in that day, Ken's like, tender offer, sweet, we're out of this, let's be done. Waited, nothing happened. All of a sudden, earnings came in, they missed it, it was ugly, they knew they couldn't finance it. They filed Chapter 11, tender was canceled immediately. The bond was reverted back to the old CUSIP, which it wasn't supposed to, and then went back, and it's just sitting until they come out of the restructuring. So something like that is so difficult to predict, and to manage through that. Usually if you see something that's really deteriorating, you're gonna see it happen over multiple quarters. And because I have to watch all 120 names that we have every day, you can kind of get a sense for that when it happens, and then Ken and I can have an investment committee discuss it. This specific instance, like with FRB, you just can't predict that kind of thing.
There is a phrase for anybody here, it comes from the mergers and acquisitions background. They used to call it a strategic bankruptcy. It was a tool for renegotiation of debt. They basically tell them, look, you're gonna redo our loan or we're just gonna file bankruptcy. That's it. And so they tried to strong arm. I think Diebold tried to get their bigger bond people to play ball with them. So I actually think it was a smart move. They forced Chapter 11. I actually think this is probably what we'll find actually when I was talking to her about the muni bond world. I think we're gonna see quite a bit of this. What's gonna happen? Bondholders they're not gonna be left high and dry. You're gonna get something, but it's gonna be longer term, lower yield, but you're getting something. It's a forced reorganization. And Diebold, it's interesting, like Steph said, it's been around a long time. I find that older companies typically don't die real quick. They managed to survive. They've been around for so long. But that is something we all have to consider, that as it's the post, was the party, the bubble. Debt was just being issued at low levels, and they never thought about, I don't think anybody honestly thought about paying it back. To say, it's out there, yeehaw, let's have a good time, and now the bills are coming due. And now we're gonna all handle it. All right, next question. We have a couple more minutes.
I got on that.
Oh, I knew it.
Well, it's a senior bond, and I just, how that stacks up in the financial structure of Diebold, and wouldn't the senior bonds be first to get everything back before they start doing anything else? I know they canceled the common.
Yeah, the common's gone for now.
Right.
Ross, they're gonna reissue it down the road. It's a reorganization of everything.
Now, Stephanie said we might only get maybe 50 or 60% of our money back, but
But
maybe they
but
could
your
just reissue a bond and put it further out or something rather
Yeah,
than.
I think it'll be further out.
Okay.
Yeah. I mean, why not? You're going through a reorganization, buy yourself some breathing room, lower the yield and
Sure.
have the debt go out further. Now, what I will tell you, I've actually said, back for those of us who remember the old LBO days, leverage buyout days, Jake, you probably remember a few of those, it's, hey, these guys were just taking on ridiculous levels of debt to take companies private. KKR was one of the big people down in Silicon Valley doing that kind of stuff. That came home to roost for a lot of companies. It's the same thing with Diebold. They took on too much debt. It was a perfectly good company. They stretched. They made a gamble on taking out this competitor out of Europe, and the bet went wrong. The CEO made a bad call. But these things always find a way of bouncing back. I think about those old LBOs. A lot of those companies, they went through these same kind of things. They're around today. We still eat RGR Nabisco products, still buy cookies. They're still in business. That stuff's still around. They don't disappear. They really don't. And also, real quick, the old Action diversification. Yes, you will probably, all of us will have a preferred stock, a bond, a common stock, something going wrong. But the one thing I can honestly say, I've never blown up a portfolio in my 30 plus years in business. There's times it hurts, but I've never flatly blown somebody up. And that's where you gotta keep a calm head and just realize that in most of our bond portfolios, we might have 40 to 45 issues. Stock portfolios might have 30. And I like them all. Many times I'm surprised at who the companies are that perform the best. But it is the nature of investing. It really is. Okay, 2 more questions and then, all right. Yes, sir.
So can you mention commodity investment?
Mhm.
So with the current inflation rate, a year from now, the buying power of any investment is going to be eroded with financial capacity.
Mhm.
And a year from now, do you see the commodity outperforming the inflation, which is the real inflation of like 6 to 7%?
I think it depends on the commodity.
Well, let's say the
Or-
portfolio of the good commodities.
Okay, so the question is about the performance of commodities, and Alex also include commodity-based companies. I think you have to kind of throw that in. Will they continue to perform well? I am not one to talk about just some sudden thing that this is one time, in 6 months do it and you're out. I believe this is a trend, and I do think that the thing about commodities, it's like saying stocks. What are you talking about? I think there's a big difference between talking about something like right now, sugar, for some strange reason, is taking off. Global demand for sugar is taking off. I know we're all thinking, just what the world needs right now. People eating more junk food. I was taken back by the size of people on the airplanes. I shouldn't say that.
Especially
Yeah.
when they sit next to you.
I tried my best to dodge that bullet. I always try to get the window seat when I can. But no, and actually the seats are getting smaller too, which is actually a little bit scarier. But the point being, I think you have to look at it as, sorry guys, I can get a little funny. I know Amy's shaking her head, can't stop. But here's the point. Yes, I think there is a place for commodities in a portfolio, not necessarily futures. Futures, you better know what you're doing. This is high leverage. Those stories you read about people blowing themselves up, yeah, those are bets. You can blow yourself up. But I do think we all should be thinking about, with inflation running for the next several years, commodities historically do well in inflation cycles. And I think on top of that, if you become adept at trading them, you can make money even after the inflation's over. But it's, again, for so long, we didn't even have to look at it because stocks are going straight up, real estate was going straight up, yeehaw, you didn't have to take the gamble. And now you have to look at other areas. So that makes sense. All right, yes, Mike?
Do you have any plans to integrate, the AI GPT bots in portfolio selection?
No, not really, and here's the thing. I believe in, and I've been doing quant work most of my career. I mean, I have been using quantitative analysis to try to remove emotion out of the decision making for a long time. My problem with this is that, yes, I think that going back to the very original time when we were playing around with computerized trading, I mean, for those of you who might remember the '87 crash, that was all computer generated, just went into a spin. If you all remember what happened in 2010 when Procter & Gamble suddenly lost 90% of its value because a computerized trading went crazy and suddenly dumped a bunch of Procter & Gamble stock. The thing is, I believe our world, and I especially think AI is a reduction tool to help companies increase their profitability, make fewer mistakes. That's all alive and well. My only caveat is, in finance, and maybe it's because I'm an old guy, is that I ride motorcycles, and I have on my bike what is called a kill switch. If my bike does anything wacky, I can shut the motor down. I just want to make sure that on any of this stuff, there is a kill switch on it if it starts really doing some strange stuff. That's all I want. Just make sure we have some, I mean, I'm just curious here, how many of you here would hop on an airplane without a pilot? No, and you work for Google. No, sir. I mean, I'm not trying to be facetious, but I mean, look at Tesla and the driving capability. That world is going that way, but I didn't see any hands go up on, yes, I'm going to just hop on a train or on an airplane and hope nothing bad happens. However, I do think we are all going to have to expect, like I talked about with banking, I think that you're going to be dealing with AI-related issues and just banking transactions. I think it'll be less people and more dealing with that kind of stuff. So I do think that part of it in our world is going to happen. Mike, every company who you own stock in, you know is moving in this direction, which maybe will make it more profitable. So, all right, yep.
Isn't trading about 95% computerized as it is?
I was actually just gonna say that, whether we would employ it ourselves, it is something that we have to deal with. So there are times when we're watching the market if it's going down, and I get why they do it. If you work for a large firm like Franklin Templeton, for example, they have so many portfolios. They have to automate the trades of where they want to have their losses stopped, right? So everything's inputted, it's trailed down, there's an algorithm and a formula to it. The second it trades through that, it sells. I get the reason behind it. They're moving trillions of dollars, right, every day. So for me, we're exposed to it, and in the market, when we see that it starts to hit certain levels, him and I will look at each other and go, oh, the machine just turned on. And they go back crazy, I won't say the word. They go nuts and they start spiraling down, and they actually cause the problem. It's a negative feedback loop that just makes it keep spiraling down until it makes it stop. So it can affect us, but we won't employ that in those in our accounts. The philosophy of having those stops in place, that we can do. That's just math, something that we look at. We have these 30 stocks, and if Apple hits this level, then it triggers something that we're gonna do, which would be to cut it or trim it or whatever it happens to be, take profits and things like that. That's part of our portfolio management, but that's a judgment call that we don't wanna take out of that process, that we make.
One other quick thing on this, and this is just because I'm a market historian, you all know that. I always love when I hear the term black swan. It's a black swan event. And I say, I don't agree. You have not gone back far enough to look. It's happened before. We are all creatures of greed and fear, emotion. This idea that it's something new and novel, now it's faster. I mean, computers make things faster. The world might get more complicated. But the reality of it is, I just don't think we're looking far enough back. So when we talk about AI and we talk about computerized things, I always go back, what are the assumptions and what's the data set they use to come up with that knowledge? Because if you if you compress a time frame, your answers are different. You expand it, it's different. So you have to, and so I typically look at multiple time frames when I'm trying to conclude a strategy. You know, come back to you, Mike, or you, Ross, with, Ken, what do you think? You know, but as time goes on, I'm learning to trust historical trends more and more, and I've learned to believe that our ancestors are not a bunch of idiots that made stupid decisions, that in many ways are actually smarter than us. I mean, I often contemplate, who would do better, us going back to their world or bringing them forward? Pretty tough people. I mean, think of any of you who immigrated here, our ancestors immigrated here. They were some pretty tough people, you know, not much. Okay, guys, any more questions? Because we're gonna have lunch and we can talk outside of lunch. Oh, go ahead, Mike.
Back to AI.
Uh-huh.
So, but what are your feelings about AI being predictive?
We'll see. I've heard this before.
Because it can analyze, you know, hundreds of thousands of data points from social media and so forth to give you kind of predictive indications as opposed to historical.
You know, the one thing about social media and trying to follow the group think of social media, I don't find it's always right.
It's usually
You know,
wrong.
but I'll also go back, well, this is my point. How far back, when you talk about predictive like knowledge, okay, we all have a body, we've been on this planet for a certain period of time, some of us longer than others, so you have more life experiences. This is an infant. This is a brand new infant that we're, and so how do you get a life full of experience into it, and how far back are you giving that knowledge? That, hey, IBM's had Watson for a long time. NASA's computers are amazing. So it's not as if we haven't had the computer power for a long time, but the more mainstream use of AI, I would talk to this gentleman right in front here. He knows much more about it than me. But yeah,
I can help and answer this question. So the AI can only get better. So if today you have certain level, then we know tomorrow is gonna learn more. So it's like predicting weather. It used to be really bad, and people are like,
Good.
you know, you don't trust. It's not a predict. We can see it today. It's getting better and better. If you see rain is coming, you look at the sky, no, really. And then in the afternoon, you see that it's okay. Same thing with AI. It's just computational power is getting stronger, and over time it's gonna get better and better and better.
Yeah, I agree with that. Yeah, it always is. You refine it. You refine the whole thing, and you add more data sets to it. So, all right, let's get some lunch. First, Stephanie, I want to thank you all. I know that you know, it's a beautiful day out. I'm sure some of the people who are going to be here are probably up in the wine country right now. But anyway, we'll have a great set of panelists after lunch to hear more about things, and I'm curious to hear more about what they all perceive going on as well. But I just want you all to know, again, I thank you for coming. It's just to see so many faces I haven't seen. Dan, I haven't seen forever. Diana, Albert, you know, Charlie, Nika. I mean, folks I have just not seen. It's great to see. I like face-to-face. I really do. I'm so sick of Zoom. Oh, I'm tired of Zoom. I'm zoomed out. All right, so this is, yeah, so anyway, let's go get some lunch and we'll talk more. Thanks. You couldn't qualify at those rates. There was no way to qualify. So if you had a loan, you were ecstatic. The point being, the good news is I don't think we're going to see that kind of draconian policy coming from the Federal Reserve. But again, we have to get used to the idea that, hey, money markets at 3, 4, bond yields, the good news, we manage a lot of bonds, Steph will talk about in a moment. The good news is yields are moving up on fixed income. But we have to begin to realize that no, the easy, sloppy, cheap, 0% money is gone. And you know what, in my personal opinion, I think the government kept it on way too long. That was supposed to be on 2008-9, and I think that there was just no political will to move rates back up. I'm not blaming anybody. I'm not trying to take a partisan view, but that should have been stopped in about 2011. It really should have. It should have. We're moving things back up, but the Federal Reserve just left it alone. So anyway, a couple other quick things. Changing investment landscape. Now I'm going to cover stocks. Steph's going to jump in on the bonds, and then of course we have people in here who know a heck of a lot more about real estate. But I'll just tell you what I see and what I think have to consider. So stock market. If you read my last Forbes article, we have this kind of surreal situation going on right now where, you know, the NASDAQ is basically called the mother of dead cat bounces after what happened to it. Sorry if anybody here's a cat lover, I apologize. But anyway, you know, it was mauled last year, it was badly hit. The NASDAQ is still nowhere near to its high of last year. It still has another, I think, 18 to 20% to go. So it's been a heck of a bounce. But the point is, what's more concerning to me, and what I wrote is at some point, all the horses have to be pulling in the same direction. What should concern everybody in this room is that we have a divergence going on where you have the NASDAQ do this, as California already has the highest tax in the country. And so I'm of the opinion that you can only push this so far, especially with people retiring. Rocky, I know we'll talk about this more in this presentation, but no, I think that we have to consider that there's going to be a serious problem on this municipal refinancing. Companies will not have the same problem. Companies have the ability to pass on we don't like it, but they can raise their prices. And usually if you need their product, you can. I just think that a lot of states, counties, school districts, water districts, Melrose, toll roads, you name it, are gonna have a very, very tough time trying to pass on those borrowing costs to the taxpayers, especially in California. So that will be what I'll say there. But Steph?
On that bright note.
Yeah.
Yeah.
Well, let's talk about good now, yeah.
Yay, rainbows. Okay, so I'll talk about the fixed income for a little bit. I think one of the big changes that I've seen this year is the amount of risk that has come into that space. You know, normally, if you've heard me talk about this before, fixed income is normally boring. It's not something that people talk about as exciting. You know, they'll talk about crypto, they'll talk about their stocks that are doing great, you know. We can have a laugh about Tesla or something like that. But, you know, you don't walk into a party and go, oh, I have this bond, it's paying me 5. Love it. And so it's just not that thing. But I feel the landscape's changed quite a bit. And what has changed for Ken and I the most is our view on risk when it comes to bonds. So I feel bad for the companies the most. They've been through a lot the last 3 years. Just look at the last 3 years. Any given company, it doesn't matter. You have COVID. Could the company have its employees shift to work from home? Yes, maybe, maybe not. Maybe you had to come to work, I'm not sure, but there was a pivot, right? And we had a nice little Goldilocks after with the recovery, but we're still trying to work through it. And there were supply chain issues, right? I remember driving across the Golden Gate Bridge and seeing ships, tankers in the bay, waiting to unload, right? We couldn't unload anything. Triggered inflation. Inflation was happening. Prices of everything went up. Companies were trying to recoup what they lost during COVID, passing those costs down. And now we have a credit issue. So companies that maybe could pivot through COVID, maybe got limped through the supply chain issues, maybe are dealing with inflation and passing costs down. Problem is consumers are changing the way they behave, right? So maybe you're not shopping as much or your shopping's changed, right? So these companies, to track and to really forecast what they're gonna earn and their cash flows, that's getting harder, right? And now we have a credit crisis. We had SCB, we had Credit Suisse, we had First Republic. You've heard me talk about it. Obviously, I work for First Republic. I'm really upset because I didn't think that was required. It's not my stay, but you know, Chase got a good deal out of that one. So the creditors are the ones that got screwed, not Chase. And I know a lot of people at FRB, and I feel bad for them. They're coming into the market, they're looking for jobs. Not a lot of them got to keep their jobs. So, you know, the space for fixed income has really turned into actually a company by company basis. You know, sometimes you can look just at sectors, sometimes you can look at maturity length, you know, you look at the fundamentals of the firm. But now when it comes to risk, it is actually company by company. You know, are you having cash flow issues? What's your debt to cap? Are you gonna be able to refinance? Because banks now, Ken can attest to this better than I can, he can probably cite every single one of them. When banks stop lending and there is a credit crisis or credit crunch, that's when the economy has real problems, right? So the company might be okay, it might have limped through, but if they can't refinance and get more backing, well, that's when everything comes to a head, right? So when we are evaluating the 120-ish names on our portfolios that we watch, because each one is gonna be situational. And you have to look at it actually on a daily basis. And that's what I do. So my job focus is turned into the portfolio management, but really risk management. Are we comfortable with what we have on our books, right? Because once you look at that landscape, you then have to go client by client and go, can I get them what they need? Can I get them the yield they need? Is it risk averse for them? Every portfolio we make is custom. So we have to make sure that I can build whatever it is that each client needs to satisfy that need with keeping risk in mind. Am I comfortable with the amount of risk in the portfolio? Do you have too much? We have special situation bonds that we always kind of consider where we allow a few of them in our portfolios, not too many, because they're higher risk, but with that higher risk comes higher yield. So you have to really balance that landscape, and in the meantime, the actual credit quality of the bonds can change quarter to quarter. So staying on top of that has really become my #1 focus in my job.
Absolutely. I'll just add a couple other quick points, and by the way, I'm glad Stephanie brings up, people used to say bonds were boring. if you think about it, there's a lot more going on there. And it was funny, I was telling some other gentlemen in the room, I don't know where Wall Street got the brilliant idea of let's buy and hold stocks through everything and let's trade bonds. Well, wait a minute, a bond has a date when it comes due, and you know exactly how much interest you're getting. You're gonna trade that, but then you're gonna just automatically always buy and hold anything through thick and thin. It should be the other way around. It doesn't mean you don't look for stocks, long-term investments that make sense. But when things start going wrong, you get rid of them. You just say enough and go. It's interesting, we talk about what happened here with First Republic, certainly with the Signature Bank, which I find comical that one of the folks who was one of the authors of the 2008 bill was on the board of that bank, Barney Frank. It just kind of comical in its own weird way. And then of course Silicon Valley Bank. I know one of the gentlemen in the room here, Jake. I mean, we talked about Silicon Valley Bank. That was, how do you describe it? This was the Goldman Sachs of the Bay Area. This is who you wanted to work. You come out of grad school, you wanted to go to work for SVB. Who would have ever guessed? But they would have made such monumental errors and just blew up. But think about this. For those of you who remember when oil busted in the early 80s, remember when suddenly oil went down, people thought, well, because inflation was finally dying down. Guess what blew up at the same time? Texas banks. Do any of you remember that back in the early 80s? Houston became a ghost town. Banks were blown up left and right out of Texas. Why? Very, very bad bets on oil. And I mean big banks, huge banks that were comparable in prestige to what happened here recently. So again, when you have changing interest rate environments, that switches things around.
You guys like, but I think of myself as more of a facilitator than anything. So if anybody's a football fan here, you know, you have your head coach, you have your wide receivers coach, you have your defensive coordinator. We don't want our offensive line coordinator teaching our wide receivers how to be wide receivers, right? So my job is to go out and find the best of the best. That's how I ran into Ken. What we did was, about 2 years ago? We were doing our due diligence on Ken as a money manager and found that his process was amazing. Most importantly, his performance, which is the number one thing that we're gonna look for, was really good. So we formed actually a joint venture, and maybe I'll have you talk a little bit more about that in just a second. Do you want to talk about it now?
No, go for it.
Okay. So my job as a wealth manager is to provide a couple of the things that Ken may not provide for his clients being a money manager. So charitable gifting, planning, tax planning, income planning, succession planning, all that stuff. So that's my job to bring that to Ken's clients, and that's what we've been doing for the last year. House. You tell somebody, this is how much money I have, this is how old I am. They'll plug some things into a computer. They'll say, here's how long it'll last. What's your risk tolerance? And then they'll print out a pretty little pie chart and say, you're going into one of our 6 portfolios. You'll hear from that person once a year. If you ask them about succession planning or tax planning, they'll look at you with crossed eyes, have no idea what to do. Now, I'm being very general in that, of course, it's not everybody. But the general difference is that the wealth managers will work with more affluent advisors, or if you don't want to call them advisors, managers, and they will provide a more robust financial planning strategy for you. Does that make sense?
Yeah, absolutely. I would also just say this, you know, I mean, we obviously know that there's a lot of advisors that work at the big firms like Morgan Stanley. We call it Merrill now, and in our day, many of us here used to work for a firm called Merrill Lynch. The point is, I always just say that, and it's not to say good or bad or anything like that, but you have to remember, at the end of the day, those people are employed.
We have about 60 to 70 different money managers, and they range all the way from options managers to core managers to large, mid, small, all of the above. And so when we were looking at Ken, what we were looking for was a core manager. And one of the things that's important to me personally, and other people might have differences of opinion, I like tactical management versus allocation management. The allocation set it and forget it model just to me doesn't work. You got to move and shake with the market. You got to hedge. You got to go heavier or lighter in cash. You got to go risk on, risk off at certain times. Ken's done a really good job of doing that. So what we found was that Ken was our core manager, where you bring in $10 million, we'll probably put 5 or 6 or 7 of it with Ken as the core, traditional, investments, stocks and bonds. And then we'll sprinkle in some other things that will not only potentially increase your return but lower your risk and your standard deviation. So for example, real estate, private credit, derivatives, you name it, we can do it. We're open architecture, we have a lot of different things, and you'll hear about a couple of them today. But that's why we value Ken and our relationship, is because he's our core manager, our traditional stocks and bonds investments, and then we sprinkle in some of the other alternative or more specialty strategies in there.
Absolutely. I think the
Pre-COVID and post-COVID, you know, we're in an environment that we, especially being in your 50s and 60s, that we really haven't seen in a long time with interest rates and what they've done. And so a lot of the calls from my clients are, you know, they noticed that the S&P 500 was down, 19% last year. The Barclays Aggregate Bond Index was down. That's a fairly rare thing for you know, to happen. And so it's a lot of fear. Stephanie was talking about the fact that fear it's all around us, and when it's
by NAR, the National Association of Realtors. Ugh. Tongue twister. We also have a podcast called the Real Estate Play-by-Play. I think, Rocky, you would love it, because we take sports analogies and compare them to real estate strategies. So I think that's something you should definitely listen to. We got one follower right here, perfect. So the number one question that we always get, like as soon as anyone knows that we're in real estate, and this literally happened downstairs at lunch, like, what is happening with the market? What's going on? And what I can say is that our team has been so busy, even just since the start of the year, but even more so, we've really ramped up in the last few months. We're working on preparing 8 different listings to come on market. We've just closed 6 transactions in the last few weeks. It feels like we're closing 1 or 2 transactions, both on the buy side and the list side. And then we're also just seeing a lot of buyers out there. As you know, like during COVID, a lot of people were kind of migrating from San Francisco into like the Marin, Sonoma market. We saw about 70% of our clients were coming from the city, whereas now it's about 15-20%, which is pretty normal. I think now that offices are calling back their workers and having them, you know, physical locations now a factor into their home search and their commute, that, you know, people are starting to factor that into their search. So we have been seeing a lot of buyers out there, even though people are staying, you know, in San Francisco. Just the other week, we had about 70 groups come through our open houses over Saturday and Sunday, and that's a lot. 70 cookies to hand out, and bottles of water to give out, you know. And I think a lot of it has to do with our lack of inventory. So it's 25% less inventory this year than it was last year, which is about the lowest it's been since 2010. So I think that's what's really driving home prices and multiple offers, is like there just isn't just not enough homes for all the buyers that are still out there. I think when the rates started going up last year, like I think Rocky mentioned, a lot of buyers were definitely pumping the brakes and taking a pause on their home search. But I feel once it kind of leveled out kind of in that 5-6% and people are just getting used to the new rates, I think, you know, the bigger picture, it's just never going to go back down to 3%. It's not going to go back to 4%. I think once people started realizing that this is the new normal, they started to research again, or started to come back and looking. And what they're doing now is just adjusting their buyer power. So we have buyers who are looking in the 1.3 million range are now looking in the 1.1 million range. So they just had to kind of adjust their criteria to get into homes now. And then for rates currently, so jumbo loans are now sitting at about 6%, and there's banks like, you know, Wells Fargo and Bank of the West that are, you know, able to kind of capture those really great rates. Conventional loans are about at like 6%, sitting at like the high 6%, and it really depends on what, like who you're asking. I think there's some mortgage brokers that are saying rates are gonna go up. Some are saying that rates are gonna go down. So I really don't think anyone knows, you know? what's gonna happen. But as far as our team, you know, whatever does happen, either way, we're either gonna stay the same amount of busy, and that's gonna be great, or we just know that we're gonna have to work a little bit harder and hustle a little bit more to kind of get those get the business and then get our clients into homes as well. So like during COVID, working in real estate was very easy. Everyone just threw business at you. You know, you could just list anything on the market and it sells so quickly. What we're seeing now is that it does take a little bit more work, even though the market is pretty high or pretty hot. It still takes a little bit of work to get homes sold. You have to really, you know, make sure that the marketing's on point, making sure it's really ready for showings, and having all of like the reports and inspections available to make quick, clean offers. Yeah, so you have to do a bit lower. So like, I think what we're seeing also is a lot of real estate agents and a lot of mortgage brokers exiting the profession just in general. So I think the hard truth is like, not everyone's gonna make it in the real estate industry. You have to be willing to really put in the work, hustle, put in the extra effort to get more business, and to also help your clients as well. I think you also have to really adjust to how you're approaching marketing. I think our teams definitely had to step outside of the box and do things that we normally wouldn't do or we hadn't had to do in the past. We're door knocking, we're literally knocking on people's door and saying like, there's no inventory, do you want to sell? We have clients, I want to live here, please. We are not below sending out postcards to every single person in the city of Novato, inviting them to drink with us at the Art Wine Festival, and then handwriting thank you notes to every single person that came by. So we're not, you know, we are taking that approach of going outside the box. I think now we really have to go back to the basics, really build those relationships with our clients and make sure we really hear what they're looking for and hear what they want, and also just making sure that we're giving them the best advice to get their home sold. You know, it's not, you can't just list something, you can't just put it on Zillow and then it just sells. Like, we really have to do a little bit more. So I think that's the kind of the value that we're bringing to our clients, like really just going outside the box there. So another question that I always get is like, what's gonna happen? What's gonna happen next? What's gonna happen next?
Good question.
It's a great question, great question. And if I had the answer and if I had a crystal ball, like, trust me, I would not be sitting here right now. I will be off traveling the world, you know, jumping in my pool of cash that, you know, like the cartoon character. So unfortunately, don't have the answer to that. I don't think anyone really does. What we do know is that the last 6 months has been a bit of a roller coaster. I have a lot of new gray hairs because of the last 6 months. And then, you know, I do believe that the next 6 months is going to be the same thing. We're just not gonna know. There's gonna be ups, there's gonna be downs. I think either way, if the rates go up, great. Like, we are in sorry, this is my colleague Kristen, that's why I keep looking at her. We're gonna be in business and we're gonna be doing great. And if it goes down, we just know that we're gonna work a little bit harder. We're gonna have to knock on a couple more doors, turn over more stones to find properties for our clients to get into. And then, so, you know, I think that's just what's gonna happen next. It's just gonna keep going up and down. I'm sure you all have heard of that FDR quote along the lines of, real estate is the safest investment in the world. Or if you are on TikTok, Snoop Dogg just recently said that if you don't own land, you don't own anything. And for all my hip TikTokers out there, is it just me? That's okay. That's okay. But yeah, I mean, there's still truth to that. You know, even though if you look in the past 30 years, there is a lot of ebb and flow, there is a lot of fluctuation, goes up and down, but if you take a step back and look, home values are still going up, and there has still been a lot of appreciation. Like, I'm sure if you ask my mom, and she tells you, she has a home here in San Marin that I grew up in, she bought her home for $250,000. It's now, this home across the street just sold for $1.2 million. So she's like, I'm never moving, I'm gonna do that here. And I was like, can you at least do it like outside so we don't have to dispose it? Sorry. But yeah, so I think, real estate is still, a really great investment. We're finding a lot of investors are taking their money out of stocks and putting them into properties, not just to flip them and resell them, but the rental market is pretty hot still, so they're actually holding them on and then using them to produce income. So that's kind of what's happening with the market right now, or what we think is going to happen, and why it's still a good investment. Let's see here. Yeah. So again, I think the big question is like, what's going to happen? Still don't know. I think the real estate market is just constantly shifting, year by year, month by month. I think sometimes it feels like week by week. Even just, I feel like a few weeks ago already feels so much different than it does today as far as like how things are moving. But overall, it's still pretty hot, still moving pretty good. So like if you have any questions, we'll have a Q&A, let me know. Our network also reaches across the country, so we're able to help all of our clients, in California and outside of California too.
I will tell you, if you check his resume out, he's tops in what he does. He's been that way for a long time. And besides the fact his skiing is greatly diminished, but his business skills have greatly gotten better. So Jim, go ahead.
My greatest skiing skill is helping pick Ken off the ground when he crashes. 'Cause every time he's crashed, I've been right there with him and had to go get the ski patrol. So, including the last one you're all aware of. So I guess to start with, yes, Ken and I initially worked together almost 40 years ago at Sutro and Company, which some of you might know the name. It was one of San Francisco's original brokerage firms and investment banks. Ken went off the money management route. I stayed on the brokerage investment banking research side. So I was a public stock analyst, the kind you see on CNBC, and I did that many times for almost 30 years. I was at Sutro, Montgomery Securities, JMP Securities, a local San Francisco firm. We recently, there for 20 years, recently sold out to Citizens Bank, one of the biggest banks in the country. And in that process, I left research. My partner in our new business left investment banking and running investment banking. I ran research. And the two of us started investing in properties, using our background, having worked with all public real estate companies, CEOs, REITs, home builders, CBRE's ownership team, all the brokerages, real estate technology, and took it to develop our own real estate fund product in the form of private equity that invests in real estate on a national basis. So we started that about 6 years ago. We're on our third, what we call Real Estate Opportunity Fund. We got a few decks. I only had a few with me. I just got back from Europe and golfing a day ago, so I didn't get very prepared and trying to get over my jet lag. And so we took an approach that we wanted to be opportunistic in what we invest in. Over the course of the last 6 years, we bought about 50 properties across the funds. We also have a couple insurance company funds investing specifically for a couple large insurance companies. But in those 50 investments, 44, 45 have been multifamily apartment buildings. So kind of playing off what Courtney said about the issues with supply and housing, and actually nationally, the number of homes listed for sale are down 50%, 25% here, but nationally down 50%. People don't have a lot of housing options, unfortunately, but if you're then a landlord, in this case, what we do, multifamily, it's been an extremely good business, knock on wood, and continues to be so. Absent the debt costs, obviously, have gone up quite a bit, just like they have for mortgage rates and everything else. Debt costs have gone up considerably, making transaction activity a lot more difficult to do, but the properties we own, the rent flow, occupancy, tenant quality has all been very, very good. So for no particular reason, we look at every market and look at how we invest on a risk-adjusted basis. So we're looking at what's the population and job growth in Austin, Orlando, Atlanta, Raleigh, compared with San Francisco, Los Angeles, any other part of the country. I've looked at lots and lots of properties in California over time, but thus far out of 50 investments, we have exactly 0 in the state of California. And on a risk-adjusted rate of return basis, I've yet to find one that makes sense in the state. And you know, you could say, but New York must feel the same. Couple of our best performing properties are in New York. We have a couple in Boston. There's been a lot of places that work. So far not here, although there's a couple in Los Angeles we actually may invest in soon that we're working on. So the target and what we're trying to do from a return and diversification standpoint is we sit in the equity position. We sit in an ownership position of the property. We have local operator partners who are experts at renovation, at management, that take care of the properties, manage them for us for a fee, and then we give them a participation in the profit and cash flow of the properties for doing so, but we put up most of the capital. Fairly typical model for private equity in general, but in this case for real estate. We have our first fund that had 15 properties in it. There are 2 left, but we returned more than double the amount of money that was invested, and the annual rates of return have been in the low 20% kind of rate. Timing was good there. If starting today on today's funds, it's harder. But we still think we'll be somewhere in the high teens to 20% type of total return. And obviously we like these segments of apartments. We've done a little bit of investing in the office sector. That's obviously, people can read the paper, look at the fact no one's going back to work other than Winans Investments. Everybody's here every day.
They never left.
Yeah, exactly. They were here during COVID. You know, there's some difficult sectors in real estate, office as being the most obvious. There's some more difficult markets based on fundamentals for demand, which is basically population and job growth. And so we've, you know, taken an approach to continue to look at multiple parts of the country you know, focus on those areas that we think have the best growth and the best return dynamics, and again, try to risk adjust it. My partner and I have a lot of money invested in it. Our client base is a lot of our old public company operators. Actually, CBRE's chairman, former chairman and CEO of the public company is our largest investor in our funds. And so we like the people we have, and they're also good advisors to us, to hopefully when we're questioning a decision before we make it, we ask them to help guide us through it. So we recently closed our 3rd fund, but we're opening up a kind of a new product. I've got a few decks in the back, but like I said, I didn't have time since I just got back from a trip to prepare more, but it can always do that, and I'm easy to find. And certainly through Ken. But we have a preferred fund product. And what I mean by that is, obviously you're all well aware of preferred stocks. It's the same idea for real estate. You sit in a position with a preferred stock that is junior to the debt, to the bonds, senior to the equity and the ownership of the common stock in a company. Likewise in real estate, that's what a preferred investment stock would be in the property. So there is with interest rates up right now, there is a dearth of available capital. I think our next speaker will address very specifically that part of that segment here on a local basis, but it is true everywhere. Just because interest rates are up so much, debt costs are up a lot, and so there's a need for capital that sits between the equity and the debt, particularly as loans on properties are maturing. And there is a onslaught of trillions of dollars coming due nationally over the next 2 years, that the loan proceeds a real estate owner can get on a property will not be equal to what they owe on the existing loan. So they're going to have to come up with new money. And that can be their equity investors, or that can be some form of new equity like a preferred. So we're targeting, and the other players that are in it target 14 to 15% total returns, and we'll typically get 7%-ish, 7.5% current income off of the rental cash flow that for that preferred investment. So that's kind of the next vehicle we're working on and just commencing now. But we look at real estate. I do it myself too. I'm a client of Ken's, of course, besides being a part owner of the business. And I greatly diversify, put my money in all sorts of different categories, from private equity to venture to stocks to bonds, and of course in my real estate. And that's kind of the way we look at people. That's managing risk, right? Being diversified, and what we do and what we offer is just one more leg of that diversification tool. And in this case, particularly for people in California, it also, I think the fact we aren't investing in California is a further form of diversification that you might not find or wouldn't find with your own home, or if you own rental homes locally. So anyway,
Great.
thanks.
Thank you.
Thank you, Jim. Very good. All right, Edward Brown, come on up. Game show.
Yeah.
All right. So I've known Edward and Mark, his business partner, Mark Humph, and for that matter, Tammy. I can tell you that, when you start talking about secondary ways of financing, I didn't really understand how important it was until I had something happen to me that changed my life. Pacific Private Money is just a fantastic group of people to work with, and they certainly have some interesting investment products, and Edward will tell you about in a moment. But as we said, there's a lot of ways, Jim brought it up, how to play real estate. There's a lot of ways to invest in real estate, as there is in stocks, bonds, or anything else. So I love it when someone says, I want to invest in real estate, it's, well, how? So here we go. Here's another way of doing it.
Thank you, Ken. Ken's the guy who got me into radio. All the way back in 2009 when we had 2 tin cans in a string. Okay, so I'm in the investor relations department at Pacific Private Money. We have our president, Mark, here, but I'm going to do the dog and pony show by myself. Now, in front of you, you don't have to look at it yet, but someone pointed out to me, there's 2 different ones. They look similar, but one says Freedom Fund, the other one says Southwest Fund. So Pacific Private Money, we have a few different funds, but let me back up for a minute. Remember how Ken was talking about earlier in the day about how difficult it is to get a mortgage, okay? So imagine Pacific Private Money as a company, we are almost exactly like a bank, like Wells Fargo, Chase, and whatever, right? You want to get a loan, our friends over here at Coldwell Banker are trying to, sell property, right? And what happens when, anybody here ever been denied by a bank for a loan? Or do you know someone who's been denied for a loan, right? Okay, first thing you do, you go to the bank and you say, hey, you got, let's say 6% money, right? But for whatever reason, the bank won't lend it to you. Maybe your FICO score is 2 points lower. Maybe you've only been on your job, and these are real situations. You've only been on your job for 18 months. You haven't been there for 2 years, okay? And people always wonder, did they say, why aren't the banks making these conservative loans? Well, I'll give you just a little bit of banking information here. Anyone know anything about reserve requirements? What that means, basically, you put $1,000 in the bank, they get to borrow money from the feds, and they can lend out, I think the number is 16 to 1, I could be wrong, 16,000, okay? So it's called a multiplier effect. That's why banks own everything. That's why they have so much money, right? But what happens when an auditor comes in and says, well, wait a minute, this guy's FICO score is 2 points lower than it should be. Or this guy's worked for 18 months instead of 2 years. Now you have a reverse multiplier effect where they say, no. Now you've got to take $16,000 off the table and you can't lend it out. That's the reason why when people walk around, they say, I can't believe I've got an 800 FICO score and I've got $1 million in the bank and they won't lend me X amount of dollars to buy my house. That doesn't make sense. Well, this is the reason. It's because the banks have to be so ultra conservative of staying within their box, okay? So now Pacific Private Money, this is where we come in. So the bank says no, or could be, we've had situations where the bank would say yes, but there's not enough time. What happens when you want to buy that house over there and you're getting a smoking hot deal on it? You don't want to move twice, but here's the catch. The seller says, I gotta close, you absolutely have to close this deal in 3 weeks. And you go, oh, okay, well, this is fine, okay, I want that house. Here's a $25,000 non-refundable deposit, let's get into escrow. And then you walk over to your bank, and your bank looks at it and says, you're a fantastic borrower. We would love to do this loan. It'll take about 60 days, or maybe 75 days, because appraisers are behind, and title companies, et cetera, whatever reason. And you say, I don't have that much time. The bank probably knows about us. We're right down the street on Grand Avenue. Go see Pacific Private Money. They'll do the loan for you, because, I mean, obviously we do our own underwriting, but for the most part, it's probably a slam dunk deal. We do the underwriting, we'll lend them the $600,000, $1 million, whatever the figure is, at very conservative rates, or very conservative loan to value, right? There's no prepayment penalty. Our specialty is the owner-occupied consumer bridge loan. You own this house, you want to buy that house, you don't want to move twice. You want to buy that house first and then fix this one up to sell it, get a little bit higher price, and then pay us off as quickly as possible, because why would you want to pay us 10% interest when the bank will give you the money, and they will give it to you at 6 or 7%, whatever the rates are nowadays, right? So you have to, and you have to pay us points. So it's sort of a love-hate relationship, right? We'll get the deal done for you, but then as soon as now you relax, you bought that house, you move into it, you fix this one up. As soon as you sell this one, you pay us off. So couple things. One, our default rate is poquito, but our main specialty is that we've got relationships with big institutions where we'll do this loan, and then we'll turn around and sell the loan. We'll package it up with a bunch of other loans, sell it to a big institution because they love our loans, and they'll give us the millions of dollars back, and then we put it back on the conveyor belt and do this again. So our default rate is very low, very low. I gotta be honest with you, as I've been in this business a really long time. I used to do financial consulting. I had my license back in the early 80s, okay? When I got into the mortgage side of things, it's more of a relaxing thing, because you don't have to worry about the principal, right? We are just like the bank. Our documents, if you were to borrow money from us, you're gonna sign the same kind of documents that Wells Fargo is gonna give you. We're gonna put a first deed of trust on the house. Sometimes we'll do seconds, but for the most part, our primary product is a first deed of trust, very conservative, on a house, all right? So we're protected, all right? So it's very, very conservative. The best part about this, in my opinion, again, right now we're just talking about the Freedom Fund for now, all right? That's our specialty, is the fact that because we are constantly selling these loans, we're packaging them up and selling them to the big boys, and then we're getting the money back, we can provide relative liquidity to your investment. Now, a lot of other investments out there, you got to tie up the money for 2 years, 5 years, 10 years, whatever. This, all we ask for is 30 days. Now, if there's a run on the bank, we might have to stretch that out a bit to, maybe 45 days or so. But the best part is your principal doesn't fluctuate, right? So you put, $100,000, well, this one has a minimum of $250. From the investment standpoint, imagine it's similar to a money market account, but you can't write checks against it. So you put in, again, this number, $250,000. At that rate, at that dollar amount, we're going to pay you 7% interest. If you put in $500,000, we pay you 8%. If you put in $1 million or more, you get 9%. Right? You get a monthly check. You can either reinvest the distribution for a compounded rate, or you can take the monthly check via ACH, and we'll just send it to your checking account. Anytime you want out, give us notice. Wait 30. We've actually cashed people out in a few days. It's possible, right? Because we're constantly getting these trades done with the big institutions, getting the money back, and then we see who's put a redemption request in, right? But a lot of times we've got so much loan power, so much volume out there. People are wondering, they go, well, what's going on in real estate? And how good is your volume, right? Well, a lot of real estate mortgage companies, because the refinance market has dried up because interest rates went up, they laid off a lot of people. But we are so busy, we could put together, I think it's at least 15 million a week. We'll probably do $750 million this year with all of our funds. So we get referrals from realtors, bankers, other mortgage brokers who can't get the deal done in time. They use us, we do the deal, and then they cash us out. We did a deal one time, I gotta say, we got cashed out in a week. Now, a bank generally, if they know they're gonna get paid off soon, they're not gonna do the deal because they have to pay their employees and they don't charge points and all that. For us, it's like, great, we'll do the deal, pay us off in a week. I mean, we make points on that, so it's really good for us. The downside on something like this, it's just strictly an income fund. So you're not gonna make your potential 18, 20, 30% a year like you may or may, like you might make at the stock market or another real estate deal. Just, a lot of people use us for just a holding period. Like, I'm not sure if I'm gonna buy another piece of real estate. I don't know if I wanna be in the stock market right now. Where can I park my money where I can get a good rate of return, really, really conservatively? And when I need it, then you can tap into it, okay? So that's our Freedom Fund. Now, the Southwest Fund, I'm actually one of the managers of that fund. And what we do there is we buy discounted mortgages. So these are mortgages that either a bank had or a hedge fund, or what we started off doing were what they call seller carryback notes. Primarily, we're in the state of Texas of that. We had, I don't think we have any California in this Southwest Fund. Okay, and back to the Freedom Fund, we do primarily California, but we can go outside of California. But on our Southwest Fund, we're buying these discounted mortgages. And on that one, the same kind of liquidity. So again, we pay a monthly distribution. You can either reinvest it or take a monthly check. That one just pays a flat 8.5%, minimum investment's $50,000, and it has a 30-day, again, same thing. Put it in there. When you want your money back, just give us 30 days notice. And that one, someone put in their request one time. We had the money sitting around because we had just gotten paid off on something. I cashed them out in 2 days. So we got this great interest rate. In fact, that was paying 8%. We raised it to 8.5% starting May 1st, okay? Out of all the funds, and again, I'm a little bit biased just because I'm one of the managers of this fund, I think this is the most conservative, the Southwest Fund. The main reason being, for the loan to value and what they call investment to value. I'll give you an example. Let's say you have a house, just to make the numbers simple, that's worth $100,000. The loan on the books, average, would be $41,000, 41% loan to value. But we bought that note at a discount. We're into it for $28,000. I mean, that's a pretty conservative. I don't know of any other fund out there that has an investment to value of 28%, and it's unleveraged. So we're not trying to lever the account. It's a clean distribution. I do have a couple of examples on here where people have paid off their mortgages early, and then we earned a little bit higher rate of return. I know I'm kind of going back and forth just a little bit. Back to the Freedom Fund for a minute. That one, we're one of a few licensed lenders in California to make these owner-occupied consumer bridge loans. Our specialty is it's an 11-month bridge loan. It gives you 11 months to sell your other property or refinance somehow and pay us off. I think the reason, I can't guarantee this, but I think the reason is because with other lenders out there, and they used to call it hard money, it's more soft money now, but with other fix and flip lenders out there who, I want to buy that property, I want to fix it up, and I want to flip it, right? They're doing fine. They're making lots of money, okay? In order to get into the owner-occupied consumer bridge loan, very specialized, right? I own this house, I want to buy that house, I want to live in it. That's an owner-occupied consumer bridge loan. You need licensing, continuing education, legal, and software. That could run upwards of $100,000, okay? Well, if you're a fix and flip lender and you're already doing well, why do you want to spend an extra $100,000 to get into a new space? Most operations are fairly small. So we're not the only ones in California, but we're one of a handful. And I think that's one of the reasons why, we're getting just lots and lots and lots of volume, okay? And on the, back on this one here. So anyway, on the Southwest Fund, oh, by the way, really quickly, on both funds, there are some tax advantages. So we're a pass-through entity. It qualifies for what they call QBID, Qualified Business Income Deduction. Ask your CPA about it, but it's possible that you might not have to pay taxes on 100% of income. You might only have to pay taxes on 80%. And on our Southwest Fund, if you're outside of California, we're not domiciled in California, and all the loans are outside of California. So if you're outside of California, you wouldn't have to pay California taxes in addition to that. So there's lots of little benefits. And like I said, been in this business a really long time, go to sleep at well really night. I go to sleep at night really well, because if anything happened to these funds, I'd hide under a rock. And, because I think that'd be the worst. And really quickly, one question that people did ask me when we did these kind of seminars when the Bernie Madoff situation was going on, and the question came up, well, how do we know you're not Bernie Madoff? Well, the thing is, all the loans that we have are recorded deeds of trust. So you don't have to take my word for it. You can actually go to the registrar's office and see, does Pacific Freedom Fund have a mortgage on that house, or the same thing with the Southwest Note Fund. So everything's well secured on that. Thank you.
Thanks, Edwin. All right, and as I said, everybody will have a chance to ask questions of our panelists once we're done here. So Jake, are you ready? You and Jim are ready. All right, there we go. Jake Rubler, listen, came all the way from Utah to come and talk to you wonderful folks. So as we talked about, the migration of the panelists has been to talk about these kind of private investments. There's other things outside what are conventionally done. And as I said earlier, it's not for everybody, but it's important to be aware of what is out there to invest in and the advantages and disadvantages. So Jake, go at it. Explain what you do.
Thank you, Ken. Jake, I'm a director at Maddox Capital. We are a $100 million growth stage private equity fund based in the beautiful state of Utah. We invest primarily, just as give you the quick and dirty on the fund real quick. We invest primarily in software, direct-to-consumer businesses, and service-based businesses. So we're a fairly agnostic and flexible fund as it relates to the who, what, where, when, why of how we invest. But at Maddox, we pride ourselves in taking a much more operationally centric and entrepreneurially minded approach. So we pride ourselves in being much more than a simple check. If you have a business that you have founded that's growing well, but you need help taking things to the next level, we're happy to provide capital to help you scale your business. But we also pride ourselves in being able and willing and have a desire of supporting you in your growth initiatives. So we are actively involved in the day-to-day of our portfolio companies and pride ourselves in that, and feel that it creates a fairly unique relationship with return potential, as well as an ability for us to decrease our risk profile given we're actively involved. So today I want to chat about macroeconomics broadly, how that's impacting my world, the private equity space, and how private equity can and should fit within folks' portfolios. So on the macroeconomic side, I'm not really going to hit on anything that hasn't been mentioned here today already in some form or fashion, but the two big things that I think are worth double clicking on is one, interest rates, right, federal funds rate, and two, broad sentiment and liquidity constraints. So on the Fed fund side, obviously coming out of the latest FOMC meeting, they decided to leave interest rates unchanged. The fact that interest rates were left unchanged, that's the first time in 10 consecutive meetings that things were not increased. So a bit of a breath of fresh air. There's been a lot of pain as it relates to a unprecedented increase in interest rates over the last year and a half. And if you attempt to distill and understand why the Fed decided to pause in their increase in interest rates, they've got one of the toughest jobs in the world, in my opinion. They've done a decent job at best, maybe a BB minus in curbing inflation, right? We've fallen from 9% inflation mid last year to 4% in current form. That's still double the target of 2%, right? So there's still wood to chop, work to be done, but they have an incredibly difficult job that I don't envy. That said, this decision to pause interest rates, I think in large part was done given there's a lot of info out there that seems to self-conflict. Right? If you look at consumer sentiment and sentiment within financial markets broadly, as well as liquidity constraints, a lot of up and down, a lot of good and bad, and nothing seems to tick and tie and agree with each other, right? If we've learned anything in the post-COVID financial market world, it's that prices maybe aren't driven by fundamentals as much as we thought or as much as they should, and that sentiment and liquidity really does drive and have a pretty notable impact on things. So on the liquidity side is fairly straightforward, and that's just a function of how much money is or isn't moving through the economy. As a lot of us here likely know, we recently hit that $32 trillion debt ceiling. That problem has been solved. That's for another 2 years, right? The fact that that is a problem, that's a separate issue. The fact that we put money on our credit card and then argue about paying it off after the fact is kind of a separate issue that I have beef with, but that's a separate point. But the concept of us hitting that debt ceiling, causes liquidity constraints broadly, and that has impacts across all markets, whether public or private, whether venture capital, private equity, real estate, whatever it may be. On the sentiment side, again, things very much self-conflict. On the good side, you have fairly robust jobs, fairly low unemployment, a recent rally in tech stocks. If you look at Q1, I believe the number is 80% of companies beat on the earnings side of things. So again, there's very much some good going on there. On the flip side, there's also some bad, right? You have inconsistency and uncertainty on the consumer side. No one knows how they should feel or spend or behave, so investors don't know how they will feel or spend or behave. There's uncertainty on the interest rate side, right? We think that there is finally a light at the end of the tunnel as it relates to where rates will land, but where will they land for certain, and how long will the pain last? How long will rates be elevated? Uncertainty there as well. You've got the commercial real estate potential refinancing, pending refinancing in Q3, Q4. So there's a lot of uncertainty macroeconomically, and ultimately, despite private capital markets and private equity being a different beast than all things public, we're impacted. We're ultimately impacted, and a lot of those impacts, it kind of centers down into 5 big buckets. The first being credit, right? We've talked a lot about debt here today, but as a private equity fund, it's our job to invest in and or acquire private businesses. So you want to buy a stock in Apple? Awesome, let it rip. Buy a stock in Apple. Anyone can do that. I can do that in 3 seconds on my phone on a million different apps through a million different brokerages. You want to buy a share in that HVAC business down the street or that tech startup down the street. That's a much more difficult task, and that is the role that private equity and venture capital provide to investors, is you're getting access to private, illiquid, non-traditional assets. Traditionally speaking, to acquire those businesses requires debt, right? And debt is much more expensive now than it was a year ago, let alone 3 years ago. And so this concept definitely impacts us in our world as private equity investors. What we were willing and able to pay for debt is now fundamentally different. But we also are in a unique situation where we have leverage as fund managers. On the back of the regional banking crisis that happened over the last few months, there's some fairly aggressive lenders out there that need, crave, and are mandated to deploy capital, right? They're looking for deposits, they're looking for good places to park capital. And so those that have leverage or had leverage have increasingly more leverage. Where funds, private equity funds in particular, were able to push and semi-bully lenders in some form or fashion in giving us better deals. So it's still expensive debt, but we have leverage, right? A great case study of that is we have a concrete masonry business that we're at the finish line of acquiring. Great, incredible little business. We're using debt to fund a portion of the purchase price there, and the lender is willing to give us a 50 basis point discount on millions and millions of dollars of debt that we're using. We're saving hundreds of thousands of dollars a year in interest expense just by giving them an extra $2 million of deposits. So again, the credit crunch, I think at face value appears to be something that's a net negative for the private equity world, but in the long run, it really does bode well for us in our world where we have leverage over lenders that ultimately need to put money to work. Worth mentioning that given a lot of the macro uncertainties, confusion, inconsistencies, whenever that happens, folks are willing to pay premium for certainty. They're willing to pay a premium for conservatism. They're willing to give up return. And so this concept of flight to quality, emphasis on cash flow positive businesses, and focus on profitability is something that's needed within our world. At Maddox Capital, we feel that we have a fairly unique model and mandate as it relates to who we look to invest in. They're ultimately, growth stage businesses that we feel have a uniquely outsized opportunity to grow and to create alpha for our investors, but they are businesses that have a line of sight to profitability or a track record of making money. They're not burning millions and millions of dollars a year with no line of sight to actually making a penny. And so this concept of the uncertainty at the macro level actually has boded well for the private equity world. And it's kind of the second point. So again, despite the macro uncertainty, first two buckets gives us more leverage and is actually net positive, given when things get uncertain macroeconomically, we have more leverage and we're able to buy things at a deeper discount, right? As JP Morgan and Rockefeller so insightfully have on their shoulders back there, in the investment world, you make money by buying low and selling high. It's simple as that. And it's a lot easier to buy low when the expectation for entrepreneurs is, there's uncertainty in the market. I know that I can't command the same premium that I once could months, years ago, right? And so again, bodes well for our ability to pay a lower price on entry and therefore create more alpha on the upside over our whole period. Another piece that's worth noting as to how the macro world is impacting our world, the private equity landscape, is a concept called dry powder. What dry powder is how much capital has been raised by funds, whether private equity, venture capital, growth, etc. There's capital that has been raised to be deployed but has not yet been deployed. It's sitting on the sidelines. It has to be deployed over a certain finite fixed period of time, but has not yet found a home per se to be parked in. That concept of there being capital on the sidelines bodes well for smaller funds. Ultimately, at Maddox Capital, we're a relatively small fund. We're a $100 million fund, but there are much bigger fish out there than us. There are funds that manage billions in a single vehicle. And so a fund of our size strongly, uniquely benefits from this concept of bigger funds being willing and able to and mandated to invest pre-dedicated pools of capital in businesses, right? The bigger funds aren't able to flex down into kind of the stage of the market that we play in, right? If you have $1 billion fund, you can't cut or you can't invest $10 million into a business. It just doesn't make sense. That's too small of a check. You're cutting $100 million checks into businesses. At Maddox, that's our strike zone. A $10 to $15 million check is exactly where we play. We feel that there's a unique opportunity to invest in, partner with, help support businesses in that specific size threshold to grow in a fairly expeditious and profitable rate, right? So this concept of there being capital on the sidelines, again, bodes very, very, very well for us and our world within private equity. The last piece that I'll mention before getting into kind of portfolio management and why, the who, what, where, when, why of private equity fitting within portfolios is the opportunity, again, within the smaller middle market section of the market, right? You have the big fish, they're managing billions and millions of dollars, the funds that we all know and love, Carlyle, KKR, Apollo, the big, sexy, if you will, behemoth funds out there. They're the mega funds. You have the middle market that's more than $100 million, but less than $1 billion. And then you have the lower middle market that's less than $100 million. Maddox Capital, we fall in that last bucket, the lower middle market. Again, very unique opportunity to be investing in bootstrapped, profitable, founder-owned businesses and to be selling to middle market and upper middle market funds. So despite there being macroeconomic uncertainty and a bit of doom and gloom, it feels like, now is the time where folks like us we are extremely excited. We are chomping at the bit, frothing at the mouth, extremely excited to be putting money to work. And that's why we feel, obviously slightly biased here, but feel that private equity can and honestly should be a piece of everyone's portfolio, depending on where you're at in your stage of life. And the reason for that are threefold. One is heightened return profile. Second, the inverse correlation to a lot of other asset classes out there, particularly publics. And third is several folks have mentioned just the concept of increased diversification. So on the heightened return side, if you look at annual performance across private equity versus public markets over the last 2 decades, call it 2000 to 2020. Private equity on average performs about 11-ish%, I believe it is, 12% a year. The S&P is about 6%. So again, there is this outsized performance in private investing as opposed to public investing. And a lot of that reason is honestly distilled down to a fairly simple concept of active management, right? When we think of active management in equities, it's your position is actively changing day in, day out. You're buying more Apple one day, selling Microsoft the next, so on and so forth. Active management within our world, we think of as our ability to, after we buy low, we're able to support, grow, scale the businesses, and it enables us to sell high faster and a heck of a lot more efficiently, right? So this active management is more operationally centric and support driven. A big mechanism as to why private equity funds and active management broadly within all alternatives and all of private capital markets is a big tool. The other piece that's worth noting is timing, right? We are in a very odd time in financial markets as it relates to a lot of the macro stuff that's been hit on today that I mentioned earlier. But if you look back at the time that's probably maybe the best comparable situation to the world that we currently find ourselves in is the Great Financial Crisis. And if you look at funds that were actively deploying, particularly in my world and private equity world, within 2007, 8, 9, there was a unique opportunity to be putting money to work, buying things at uniquely low prices that were still fundamentally strong, but people get skittish when stuff gets confusing, right? When in reality, that's the opposite of what how we think about, right? When times get confusing, if you have an asset that's performing exceptionally well, that has outsized growth potential, is profitable, and the entrepreneur's expectation is lowered given macroeconomic uncertainty, we can buy the thing for a cheaper price now than we could 6 months ago. That's an exceptionally favorable outcome for us. And if you look at how the statistics shake out, 75% of private equity funds that were deploying in 2008 and 2009 beat public market managers, right? So again, unique opportunity to be putting money to work in private capital markets given some of the macroeconomic uncertainty. Active management begets a lower volatility, lower risk profile, and this opportunity for higher alpha. 2 last points. Diversification is fairly straightforward, right? I mean, private equity can and should be a tool in the toolkit given it increases exposure to a new asset, different geographies, different go-to-market motions, different verticals, etc. Inverse correlation. There's an inverse correlation between private equity returns and public market returns. So again, we're typically when one does well, the other does not. And so in the time of public uncertainty, we perform and thrive incredibly well. And we view that as an opportunity moment right now, as well as the inverse correlation between price to earnings ratios, PE ratios, or public market valuations, and fund vintage, meaning the year that a fund is founded. So when a fund is founded when the stock market is down, that's typically going to yield outsized results. So again, I'll kind of pause there at the risk of continuing to get more and more rambly. My father didn't bless me with a lot of good things, but he blessed me with the skill to just ramble on and on and on. So my regards. I'm sorry, but hopefully that kind of provides some semblance as to how the macro environment confusion and inconsistency is impacting our world, and kind of why private equity can and should be a piece of the toolkit.
Great.
Thank you, Jake.
All right, listen.